Something is happening in the silver market that most investors aren't prepared for. While the financial media focuses on stock market headlines and cryptocurrency volatility, a quiet transformation is taking place in one of the world's oldest monetary metals. Silver is positioning itself at the intersection of monetary demand, industrial necessity, and macroeconomic uncertainty in ways we haven't seen in decades. I'm here today not to sell you a dream, but to walk you through what's actually happening in this market, to help you understand the forces at work, and to give you the framework you need to make intelligent decisions, whether you currently hold silver or you're considering your first position. The potential move to triple-digit prices isn't based on hope or speculation. It's rooted in fundamental supply constraints, unprecedented industrial demand, and monetary conditions that favor hard assets. But understanding this opportunity requires us to look beyond the noise and examine what's really driving this market. Over the next 25 minutes, we're going to analyze this situation with the seriousness it deserves. No hype, no guarantees, just clear thinking about a significant market development that could impact your financial future. Let's begin. Silver occupies a unique position in global markets. It's both a monetary metal and an industrial commodity. This dual nature creates dynamics you won't find in gold, copper, or any other single asset class. On one side, silver has served as money for over 4,000 years. It remains a store of value, a hedge against currency debasement, and a safe haven during financial instability. Central banks may not hold it in reserves like they do gold, but private investors worldwide recognize its monetary properties. On the other side, silver is absolutely essential to modern technology. Solar panels, electronics, medical devices, water purification systems, and electric vehicles all depend on silver's unmatched properties. It's the most conductive, most reflective, and most thermally efficient metal on Earth. There are no substitutes for many of these applications. This dual nature means silver responds to both monetary conditions and industrial demand cycles. When these two forces align, as they're beginning to now, the price movements can be substantial and sustained. Let's talk about what's actually happening with silver supply, because this is where the story gets interesting. Global silver production has been essentially flat for years. We're not discovering major new deposits. Existing mines are aging. The ore grades are declining, meaning miners must process more material to extract the same amount of silver. Here's something most people don't realize. About 70% of silver comes as a byproduct of mining other metals, primarily copper, lead, and zinc. Silver miners don't simply decide to produce more silver when prices rise. Production is tied to these base metals, and their economics drive mining decisions. Meanwhile, above-ground inventories have been declining. The silver held in exchange vaults, investment products, and strategic reserves has dropped significantly over the past several years. We're consuming more than we're producing, and we have been for quite some time. This creates an inelastic supply situation. When demand surges, supply can't quickly respond. The market must adjust through price. Now let's examine the demand side, because this is where the dynamics become truly compelling. Industrial demand for silver is accelerating. The global transition to renewable energy isn't a political talking point anymore. It's happening. Every solar panel requires silver paste for the photovoltaic cells. As countries worldwide expand solar capacity, silver demand from this sector alone is projected to increase dramatically. Electric vehicles use significantly more silver than traditional combustion engines. The wiring, the electronics, the charging infrastructure all require silver. As EV adoption grows globally, this demand stream intensifies. The electronics sector continues expanding. Smartphones, computers, servers, 5G infrastructure, artificial intelligence data centers, all of these technologies depend on silver's superior conductivity. Medical applications are growing as well. Silver's antibacterial properties make it essential for wound care, medical devices, and hospital equipment. This demand is steady and non-discretionary. Then we have investment demand. This is where investor psychology and monetary conditions enter the picture. Consider the broader macroeconomic landscape we're operating in. Government debt levels across developed nations have reached peacetime records. Deficit spending continues regardless of which political parties hold power. The mathematics of sovereign debt are becoming increasingly challenging. Central banks responded to recent crises with unprecedented monetary expansion. Yes, interest rates have risen from their lows, but real rates, nominal rates minus inflation, remain historically suppressed in many economies. Currency debasement isn't a conspiracy theory, it's observable policy. When governments create currency faster than economies create real wealth, the purchasing power of that currency declines over time. This is basic economics. In this environment, hard assets with limited supply become increasingly attractive. Investors seek stores of value that cannot be printed, that have intrinsic utility, and that have maintained purchasing power across centuries. Silver fits this description. But unlike gold, which trades primarily on its monetary premium, silver offers the added dimension of industrial demand growth. Let's look at what history teaches us about silver market cycles. Silver doesn't move in a straight line. It experiences long periods of consolidation followed by explosive advances. In the 1970s, silver moved from around $2 to over $50. In the 2000s bull market, it went from around $4 to nearly $50 again. These weren't smooth, steady climbs. They were punctuated by sharp corrections, periods of doubt, and moments when conventional wisdom declared the rally over. Yet each cycle had fundamental drivers that ultimately pushed prices far higher than most analysts initially predicted. What's crucial to understand is that major silver rallies don't happen in isolation. They occur during periods of monetary uncertainty, inflation concerns, and crisis of confidence in fiat currencies. They happen when industrial demand is strong and supply is constrained. We're seeing these conditions align again. The ratio between gold and silver prices also provides important context. Historically, this ratio has averaged somewhere between 40 and 60 ounces of silver to 1 ounce of gold. In recent years, this ratio has varied wildly, sometimes exceeding 80 or even 90 to 1. When silver is historically cheap relative to gold, and when the fundamental drivers we've discussed are in place, the conditions exist for silver to outperform in percentage terms. This is what we call ratio compression, silver catching up to gold in relative value. Here's where understanding human behavior becomes essential. Most investors are currently underweight silver. The asset management industry, pension funds, and family offices hold minimal positions compared to their allocations to stocks, bonds, and even gold. Silver remains a forgotten asset class in institutional portfolios. This creates opportunity. When an asset is underowned and fundamental conditions improve, the potential for capital inflows is substantial. As more investors recognize the supply-demand imbalance, as the industrial demand story becomes more widely understood, portfolio allocations could shift. But there's another psychological factor at work: disbelief. After years of sideways trading and false starts, many investors are skeptical that silver can sustain a major rally. This skepticism creates resistance at each price level. Investors sell too early, convinced the move can't continue. This actually extends the runway of the bull market, as it prevents the kind of euphoric blow-off top that signals an immediate end. The path to significantly higher prices won't be straight. It will test your conviction. There will be pullbacks that make you question the thesis. This is normal. This is how bull markets and commodities work. While fundamentals drive long-term prices, technical factors influence timing and momentum. Silver has been building a base for years. It's established clear support levels and demonstrated the ability to absorb selling pressure. The longer a base builds, the more powerful the eventual breakout tends to be. Trading volumes and futures market positioning also matter. When speculative positioning is excessively bullish, markets often correct. When positioning is neutral or even bearish, while fundamentals are improving, that's when sustained moves can develop. Currently, we're seeing measured optimism in silver markets, not euphoria. Commercial hedgers, who are typically right about major trends, have reduced their short positions significantly. Large speculators aren't overly extended to the long side. This is healthy positioning for a sustained advance. Many investors ask, what will be the catalyst that sends silver significantly higher? The truth is, we rarely recognize the catalyst in real time. It might be a currency crisis in a major economy. It could be a supply disruption at major mining operations. Perhaps it's a policy shift that accelerates green energy adoption beyond current projections. Or maybe there's no single dramatic catalyst. Sometimes markets move simply because the fundamental imbalance becomes too great to ignore. Price is the ultimate information signal. When price begins rising persistently, it attracts attention, which brings capital, which pushes price higher still. Trying to predict the exact catalyst is less important than understanding whether the underlying conditions support a major move. In silver's case, those conditions are clearly present. If you already own silver, whether in physical form, mining shares, or investment vehicles, you're positioned for what could be a significant wealth-building opportunity. But your strategy now must focus on patience, discipline, and avoiding self-inflicted mistakes. First, understand your position size. Are you appropriately allocated? Silver should be part of a diversified portfolio, not your entire net worth. If you're overweight, consider whether you can emotionally handle the volatility ahead. If you're underweight, relative to your conviction in this thesis, you may want to consider measured additions during pullbacks. Second, have a framework for managing the position through volatility. Silver will not rise in a straight line. There will be days, even weeks, where prices drop sharply. These corrections are normal and healthy. They shake out weak hands and build the base for the next leg higher. Create mental or written rules for yourself. Perhaps you'll add to positions on any pullback exceeding 15%. Maybe you'll take partial profits at certain price levels to reduce emotional stress. Whatever your approach, decide it now before emotion clouds your judgment. Third, resist the temptation to trade around your core position. Many investors destroy wealth trying to catch every swing, selling at minor tops and buying back higher, or missing the big moves entirely because they're on the sidelines. If you believe in the long-term thesis, maintain a core position and let the major trend do the heavy lifting. Fourth, stay informed, but don't get lost in daily noise. You don't need to check prices every hour. You don't need to react to every analyst opinion or news headline. Have trusted sources for fundamental information, review them periodically, and tune out the rest. Fifth, consider the tax implications of your holding structure. Physical silver, ETFs, mining shares, and futures all have different tax treatments. Consult with a tax professional to ensure you're not creating unnecessary liabilities. Finally, have an eventual exit strategy, even if it's years away. No bull market lasts forever. At some point, you'll want to convert these gains into other assets or uses. Think about what conditions would signal that the opportunity has run its course. Is it a certain price level? A shift in fundamental drivers? A feeling of euphoria in the market? Decide this framework now while you're thinking clearly. If you're considering entering the silver market for the first time, your approach should emphasize education, gradual positioning, and risk management. Start by understanding what you're buying. Physical silver comes in coins and bars of various sizes. Exchange-traded funds offer exposure without storage concerns, but carry counterparty risk. Mining stocks provide leverage to silver prices, but add company-specific risks. Silver futures and options are complex instruments suitable only for experienced traders. For most investors, physical silver or a reputable ETF makes sense as a starting point. Physical gives you direct ownership and no counterparty risk, though you must arrange storage and insurance. ETFs offer convenience and liquidity, though you're trusting the fund structure and custodian. Don't feel pressured to establish your full position immediately. Markets always offer opportunities. Consider a dollar-cost averaging approach over several months. This removes the psychological burden of trying to time the perfect entry and ensures you capture an average price across different market conditions. Start with an allocation you can sleep with. For most balanced portfolios, silver might represent 5 to 10% of total holdings, though your personal circumstances and risk tolerance should guide this decision. You can always add more if your conviction grows and the thesis plays out. Educate yourself continuously. Read about silver's role in monetary history, understand the supply chain from mine to market, follow industrial demand trends in solar, EVs, and electronics. The more you understand the fundamentals, the easier it becomes to hold through volatility. Accept that you will likely experience buyer's remorse at some point. If you buy and prices immediately drop 15%, that's uncomfortable but normal. If you buy and prices immediately rise 20%, you'll wish you purchased more. These feelings are part of investing. What matters is whether your thesis remains valid, not whether your timing was perfect. Consider the relationship between silver and the rest of your portfolio. Silver often performs well when stocks struggle, particularly during inflationary periods or financial stress. This negative correlation can actually reduce overall portfolio volatility while providing upside potential. Set realistic expectations about timeframes. This is not a get-rich-quick opportunity. Building significant wealth through silver likely requires a multi-year horizon. You're positioning for a major trend, not a quick trade. Finally, only invest capital you can afford to hold for the long term. Silver is volatile. If you might need this money in 6 months, it doesn't belong in silver. If you're investing rent money or emergency funds, you're setting yourself up for forced selling at the worst possible time. Regardless of whether you currently hold silver or are just entering, the psychological aspects of this investment will test you. The first challenge is doubt. You'll read articles explaining why silver can't possibly rise. Respected analysts will provide compelling arguments for why the bull market is over. Friends and family may question your judgment. This is normal. Every contrarian investment requires conviction in the face of skepticism. The second challenge is impatience. Major trends take time to develop. You may experience months where nothing seems to happen. This is actually healthy market behavior. Consolidation builds energy for the next advance. Impatience leads to abandoning positions just before they pay off. The third challenge is fear during corrections. When silver drops 10, 15, or 20% in a matter of weeks, it feels terrible. Your portfolio value is declining. The thesis seems broken. This is precisely when strong hands accumulate and weak hands sell. Understanding that corrections are normal helps you navigate them. The fourth challenge is greed during advances. When silver rises sharply and your position shows substantial gains, you'll be tempted to buy more aggressively or to leverage up. This is often a mistake. The best returns typically go to those who built their positions patiently and then held through the advance, not those who chased after prices had already run. Managing these psychological challenges requires self-awareness and predetermined rules. Know your emotional triggers, have a plan, follow the plan. Review and adjust only when fundamental conditions change, not when emotions spike. Let's talk specifically about how much of your portfolio should be in silver. There's no universal right answer. It depends on your age, income, risk tolerance, other holdings, and investment goals. But some general principles apply. Silver is a volatile asset. It can drop 30% in a few months. If that kind of movement would cause you to panic and sell, you're positioned too heavily. You should be able to see a significant decline and think, that's unfortunate, but my thesis hasn't changed, rather than, I need to get out immediately. For most investors, silver fits into the alternative assets or inflation hedge bucket of a portfolio. This might be 5 to 15% of total holdings for someone who believes strongly in the thesis, or 2 to 5% for someone taking a more cautious approach. Don't make silver your only alternative asset. Gold provides similar but distinct benefits. Real estate, commodities, and certain business investments also offer inflation protection and diversification. A balanced approach to alternative assets is wiser than concentrating everything in a single metal. Also consider your silver allocation across different vehicles. Perhaps you hold some physical metal for the security of direct ownership, some in an ETF for liquidity, and some in well-managed mining companies for operational leverage. This diversification within your silver holdings provides flexibility and reduces specific risks. Many investors ask about silver mining companies as an alternative to owning the metal directly. Mining stocks offer leverage. When silver prices rise, profitable miners see their earnings increase dramatically because their production costs are relatively fixed. This can lead to stock prices rising 2 or 3 times as much as the underlying metal. But this leverage works both ways. Mining stocks also carry operational risks, management risks, political risks in the jurisdictions where they operate, and correlation to broader equity markets. During market stress, mining shares can decline even when silver prices are stable or rising. If you choose to include mining stocks, do your homework. Understand the company's cost structure, reserve base, management track record, and balance sheet. Favor companies with low costs, long mine lives, and proven management teams. Avoid highly leveraged companies or those operating in unstable political environments unless you're comfortable with the additional risks. Consider that mining stocks perform best in the middle stages of a commodity bull market, when the trend is established, but before euphoria sets in. They often peak before the metal itself. This means you may need a different exit strategy for mining shares versus physical silver. A balanced approach might include a core position in physical metal or ETFs, supplemented by a smaller position in quality mining companies. This gives you the stability and purity of metal exposure while capturing some of the leverage potential from well-managed miners. Now, let's discuss the behaviors that destroy wealth in markets like this. These mistakes are common, predictable, and entirely avoidable if you maintain discipline. The biggest destroyer of wealth in volatile markets is emotional decision-making. Buying when you feel euphoric and selling when you feel fearful is a perfect formula for buying high and selling low. Fear and greed are powerful forces. They override rational thinking. They make you abandon well-reasoned plans at the worst possible moments. The investors who build wealth in markets like this are those who make decisions based on analysis, not emotion. If you find yourself obsessively checking prices, losing sleep over market movements, or feeling compelled to act based on short-term price changes, you're at risk of emotional trading. Step back. Review your thesis. Remember why you invested in the first place. If the fundamentals haven't changed, your strategy shouldn't either. Leverage magnifies both gains and losses. Using margin, futures contracts, or options to increase your silver exposure beyond what you can afford to lose is gambling, not investing. I've seen investors turn modest positions into life-changing wealth through patient accumulation and holding. I've also seen investors destroy themselves through leverage, getting stopped out of correct positions because they couldn't weather normal volatility. If you can't sleep at night because of your position size, you're over-leveraged. If a 20% decline in silver prices would significantly impact your financial security, you're over-leveraged. If you're using borrowed money to invest in silver, you're over-leveraged. Use leverage only if you deeply understand the risks, have extensive trading experience, and are using it tactically rather than as a core strategy. For most investors, unleveraged positions in physical metal, ETFs, or mining shares are the appropriate approach. When silver is rising rapidly and media attention increases, late-arriving investors often pile in at the worst possible moment. They chase performance, buying after the big moves have already occurred, right before a healthy correction. The time to build positions is during the quiet periods, when nobody's talking about silver, when prices have been consolidating, when it feels boring. Not when your neighbor is bragging about their silver gains and financial television is running special segments on the commodity boom. If you find yourself wanting to invest only because prices have risen dramatically, examine that impulse. Are you responding to fear of missing out rather than fundamental analysis? Are you buying because everyone else is, or because the underlying thesis makes sense? Some investors buy silver, watch the price, and completely ignore the fundamental factors that actually drive long-term value. They trade based on price charts, social media sentiment, or tips from random sources without understanding the supply-demand dynamics. Your investment thesis should be rooted in fundamentals: supply constraints, industrial demand growth, monetary conditions, and historical patterns. These are the factors that drive multi-year trends. Price charts and momentum are secondary. When fundamentals change, you should reassess. If major new silver discoveries suddenly increase supply, if industrial demand plateaus, if monetary conditions shift dramatically, these changes matter. But day-to-day price movements without fundamental changes are just noise. For those who choose physical silver, security cannot be overlooked. Storing significant amounts of precious metals in your home creates risks, theft, fire, loss. Telling people about your holdings multiplies these risks. If you hold physical metal, invest in proper storage. This might be a high-quality safe, a bank safety deposit box, or professional vault storage. Never advertise your holdings. Maintain privacy. Ensure adequate insurance coverage. The worst outcome is building a significant position and then losing it to preventable circumstances. Secure storage is part of your investment cost. Factor it in. Different silver investments have different tax treatments. In some jurisdictions, physical silver is taxed as a collectible at higher rates than other capital gains. Mining stocks may qualify for different treatment. ETFs have their own structures and tax implications. Failing to understand these differences can result in giving back a large portion of your gains to taxes when you could have structured things more efficiently from the start. Consult with a qualified tax professional before making significant silver investments. Understand the rules in your jurisdiction. Consider holding structures that might offer tax advantages. This planning, done up front, can save you tens of thousands of dollars later. The internet is filled with people claiming expertise in precious metals. Some are knowledgeable and honest. Many are not. Some have conflicts of interest, selling products or services while masquerading as objective analysts. Others simply don't know what they're talking about. Vet your information sources carefully. Look for people with track records, skin in the game, and transparent methodologies. Be skeptical of extreme predictions, guaranteed outcomes, or anything that sounds too good to be true. Develop your own understanding rather than blindly following any single expert, including me. The best decisions come from your own analysis, informed by quality sources, not from outsourcing your thinking to someone else. If silver performs well over the coming years, it could grow from 5% of your portfolio to 20 or 30%. This concentration exposes you to unnecessary risk and violates basic diversification principles. Successful investors periodically rebalance, taking profits from outperforming assets and reallocating to underweight areas. This feels counterintuitive, selling your winners, but it's essential for long-term wealth preservation. Set rules for rebalancing. Perhaps you'll trim positions if any single holding exceeds a certain percentage of your net worth. Maybe you'll rebalance annually, or when allocations drift beyond predetermined bands. Whatever your approach, maintain discipline about it. Some investors spend so much time trying to find the perfect entry point that they never establish a position. They wait for a pullback that never comes, or they do endless analysis seeking certainty that doesn't exist. In investing, you rarely have perfect information. You can't eliminate all risk. At some point, you must act based on the best analysis available. Waiting for perfect certainty means missing opportunities. A reasonable position entered at a decent but not perfect price, held with discipline, outperforms no position at all. Don't let analysis paralysis prevent you from acting on your convictions. Perhaps the most common mistake is having a plan and then abandoning it when emotions spike. You decide you'll hold through corrections of 15%, but when it actually happens, fear overwhelms you and you sell. Or you plan to take partial profits at certain levels but get greedy and hold for more. Your plan should be created during calm, rational moments. It should account for volatility, corrections, and emotional challenges. Once created, follow it. Modify it only when fundamental conditions change significantly, not when you're feeling fear or euphoria. The plan is your protection against yourself. Respect it. We've covered substantial ground. Let's bring it together. Silver stands at an inflection point driven by fundamental forces: supply constraints, accelerating industrial demand, and monetary conditions that favor hard assets. The potential for significant price appreciation exists not because of hype or speculation, but because of structural imbalances in the market. Whether silver reaches specific price levels cannot be predicted with certainty. Markets are complex systems influenced by countless variables. What we can say with confidence is that the conditions are present for a sustained bull market, and that investors who position intelligently have the opportunity to benefit substantially. But opportunity alone means nothing without proper execution. The investors who build wealth through this trend will be those who maintain discipline, manage risk, control emotions, and think in multi-year timeframes. If you currently hold silver, your task is patience. Resist the urge to trade, weather the volatility, keep your eyes on the fundamental drivers, not daily price movements. Let the thesis play out. If you're considering entering the market, your task is education and measured positioning. Understand what you're buying. Start with an allocation you can hold comfortably. Build gradually. Focus on the long-term picture. For everyone, the tasks are universal. Think clearly, act rationally, and maintain perspective. Remember that markets exist to transfer wealth from the impatient to the patient, from the emotional to the disciplined, from those who react to those who plan. Which category you fall into is entirely within your control. The coming months and years in the silver market will test you. There will be moments of doubt, fear, and euphoria. There will be corrections that feel devastating and advances that feel too good to be true. This is the nature of commodity markets. What separates successful investors from the rest is not superior intelligence or access to secret information. It's the ability to maintain composure, follow a rational plan, and keep emotions in check when everyone around you is losing theirs. You now have the framework to understand what's happening in the silver market. You understand the supply dynamics, the demand drivers, the monetary backdrop, and the historical context. You have guidance appropriate to your current position and warnings about the mistakes to avoid. The rest is up to you. Make your decisions based on careful analysis, not fear or greed. Size your positions appropriately. Create a plan and follow it. Stay informed, but don't get lost in noise. Think in years, not days. Whether silver ultimately moves to triple digits or not, the investors who approach this opportunity with discipline and intelligence will benefit from their participation. The wealth building comes not from perfectly timing markets, but from positioning yourself appropriately and having the fortitude to hold through the inevitable turbulence. We're potentially at the beginning of a significant market development. These opportunities don't come along often. When they do, they reward those who prepare, position, and persist, respect the risks, control what you can control, trust the process, and give yourself permission to succeed by maintaining the discipline to see this through. Your financial future is built through thousands of small decisions compounded over time. The decision to understand silver's potential, to position appropriately, and to manage that position with intelligence could be one of the more significant decisions you make this decade. But only if you approach it with the seriousness it deserves. The market doesn't care about your feelings. It doesn't care about your timeline. It will do what it will do based on the fundamental forces we've discussed. Your job is to position yourself intelligently, and then let those forces work in your favor. You have the knowledge, you have the framework, you have the warnings. Now apply them with discipline, patience, and conviction. The opportunity is real, the risks are manageable, the potential is significant, the rest is execution. Thank you for your time and attention. I hope this analysis serves you well in the months and years ahead.